Hey, everybody. Good to be here today. My name is Brent Moores, and it's time for Managing an Options Portfolio. We do this each week at this time, and I welcome you, whether you've a frequent attender or a first timer. We're glad to have you, and if you're watching on a recording, that's fine too. Just glad to have you. Hey, I'm joined in the chat by Connie Hill, who's helping me out. So if you're watching live and have questions, feel free to type those in the chat. Between Connie and myself, we'll do our best to get your questions answered. And hey, earnings season is just about upon us next week. That's kind of where I want to put a little more focus on today is earnings. What do we do with earnings? So we're going to talk about that coming up in just a minute. A reminder, you can follow myself or Connie on X for additional financial content throughout the week at Brent Moore CS, at Connie Hill CS. Now, before we get too far into this, let me remind you that options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in the money amount. Rolling strategies can entail additional transaction costs. The material today is intended for general informational and educational purposes only. The paper money software application, which is what we will be using, Thinkorswim desktop software, paper money version, it is provided for educational purposes only. I'm probably not going to factor in commissions into my trades, sample trades we do, but just realize that commissions are a factor that do play a role. And Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including loss of principal. And past performance is no guarantee of future results. Let's head on over to that Thinkorswim platform and just take a quick check on the markets. Up about 2.5%. We've actually held up pretty well today. Obviously, we had a big gap up. I'm just looking at the S&P 500. But, a big gap up doesn't mean that it's going to continue up or continue high. A lot of times we'll see a big gap up and it kind of sells off throughout the day. We've actually held up pretty well from a technical standpoint. This is the open price, kind of right about there. That's the open price. Let me just zoom in here just a little bit so you can see this. Let me just try this here. Right about there. That's the open price. We're above that right now, and that's what we want. We want it to stay above that. So that's a good thing. Now, let's go and let's talk about earnings, because I said earnings season is upon us. And what I want to just make sure is you understand what we mean by that. Each quarter, companies release their earnings, their financial results. So 4 times a year. Typically, there's no set time frame they have to release them, but typically they release them, and the end of the first quarter is the end of March. Well, by the time the company releases the earnings, the accountants and financial people need to do their thing. Usually it's a couple weeks after that. 2 weeks after that is when the first earnings comes out. You can see that on the Thinkorswim platform by going to the Market Watch tab, selecting earnings here. Oh, make sure you're on the calendar right up there. Select earnings, and you may have like a lot. You can narrow it down over here, by the way, if you want. Instead of showing every company that has earnings, you can go to this little gear, click on the gear, and you can go to public, and you can you can set a watch list of what you want to look at. So in this case, I'm just going to do S&P 100, the kind of the 100 biggest stocks. And I have this in list view. You can have it in different views. That's fine too. No problem there. But let me click on list. And I'm just going to go by date. And you can see we had March 31st, Nike. And then all of a sudden, a couple week gap. And April 13th, April 14th, 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 a whole bunch of, this is Tuesday, the 13th, I think is Tuesday. Or is that Monday? It is when earnings season kicks off. Now, look at the symbols. Goldman Sachs, BlackRock, Citigroup, Johnson & Johnson, JPM, Wells Fargo, Bank of America, Morgan Stanley. Do you see something in common with all those? Those are all financial companies, and that's how earnings season traditionally kicks off. But regardless of that, that just means over the next 3-4 weeks, a lot of companies are going to have earnings. And now, what's affecting the market right now, a lot of it is news out of the Middle East, right? You guys all know that. But when earnings season comes about, that doesn't go to the side. Obviously, that's still going to affect things. But corporate earnings can affect, obviously, they affect the economy, and it can affect the markets as a whole. But when we look at individual companies, it's important to realize individual companies are going to come out with earnings, and the stocks tend to be more volatile when earnings come out. You guys that probably makes sense, I would think. Stocks react to earnings up or down. Or maybe they don't move much, but usually they move up or down, but you just never know. But that can affect your decision to enter trades. It can also affect your decision to manage existing trades. Do you want to be in a trade when earnings is going to come out, or do you want to avoid it? Sometimes people will intentionally target a trade that's a stock that's about to come out with earnings for a trade. We'll give you an example of that in just a minute. Sometimes people deliberately avoid trading companies that have earnings coming out. Why? They want to avoid the extra volatility. Now, as an option trader, which is what we're talking about today, implied volatilities, in other words, the price of options goes up typically before earnings. That means options are more expensive. If you're a seller, you're bringing in more premium. However, after earnings come, you're bringing in more premium, which is great. However, from the perspective of an option seller, however, there's more risk that the stock can move against you farther. And so you're being compensated for the increased risk. As an option buyer, you have to pay more for the options. Bummer. However, the stock has more chance for it to move even further in your favor, perhaps. So you have to pay more, but there's perhaps more potential benefit there. So it kind of washes out in a sense. You just have to decide. Some people are fine trading and holding through earnings. Some people aren't. But we're going to look at different trades today where earnings could affect it. Okay, so that's kind of how I wanted to start. Now, if I look at my existing portfolio, I can look at these. I have a little column here. It's days till earnings. Let me just increase that for you. This is actually a special script. If you are interested in this script, I'm going to post it in the chat for you, and just realize scripts aren't guaranteed for timing or accuracy. I'm going to post that in the chat. And if you're watching it on a recording, I posted it in the description of this webcast if you'd like to use it. Okay. This just tells me how many days till earnings are coming out. And so I can see on these trades, there we go. And that just makes it easy. You don't need that script necessarily. You can see here, if you look at some of these, let me just find one that's coming up, like Capital One, 9 days till expiration. Do you see this blue and red little symbol? That just means earnings is approaching. Okay, it doesn't tell you the exact number of days, but it tells you earnings is approaching. If you pull up a stock, let me just pull up COF, you can see the earnings right here on the chart. Okay, you may need to give yourself a little extra room on the chart. How do you do that? How do you get it so the last piece of data isn't all the way snug to the right into the chart? You can do that by going up to the gear, going up to time axis, and adding an expansion area to the right side. I have 10 bars. If I make that 20, you can just type in whatever number you want there. If I make that 20 and apply that, it gives me even a little bit more wiggle room there. And then what we can see is we can see where our earnings is. If you don't have any of these symbols on the chart, this is a dividend, these are earnings. Again, you can go to the gear and you can go to under equities, go to show corporate actions. Make sure that is checked. Okay, so that's just right up there. Okay, so that's how we can see earnings on a chart. Now, if we deliberately want to target earnings, some people will do that. For example, let me just take one of those financial stocks, Bank of America. We've got earnings coming up. Okay, earnings there on the 14th or 15th there. Maybe that's the 15th. So that's just about a week away. And so there's different approaches that people take with earnings. And one of them is they will do what is called a straddle. Okay, they'll do what's called a straddle. And what a straddle is a strategy where you buy a call and you buy a put. Okay, so I'm just going to put a plus C for buy a call, and you do a plus C or plus B, plus P for buy a put. You buy those, it costs you a certain amount of money. If the stock goes way up, then the call probably will do great, and the put will probably do terribly. It has to move enough, but if it moves enough, the money you make on the call will make up for what you lose on the put. If, on the other hand, the stock goes down a lot on earnings, because we don't know what's going to happen, hopefully the money you make on the put makes up for the money that you're going to lose on the call in that scenario. And if the stock kind of goes sideways-ish or more or less kind of not much of a move, you're probably going to lose on both the call and the put in this case. All right. So how much does it have to move? Let's just talk about that. Here's Bank of America. I'm going to go to the trade tab, and I'm going to pick a date that's past earnings. Okay. We have earnings, which was on the 15th, I think. I'm going to go to date past earnings. And if I look at these options, what I can do is I can look at the straddle price. Let me just click here and go to straddle. Okay. And I'm going to go at the money. Well, the stock's about almost $52. So I'll just go $52. The price of that is about $250. I'm just going to round a little bit. It's a little less than $250, around $240, $250. That's saying between now and this date right here, this expiration, the market is expecting about a $2.50 move. Okay? About a $2.50 move. Now, how is it coming up with this price? It's coming up with this price by just adding the price of the call and the put. So how's it coming up with that 250 right there? It's just adding the price of the call and the put. So if I were to just go to single and take this price and add it to this price, that would be our straddle price. Basically, what we need is we need the move to be more than that in order to make money on it. Well, let's look at that visually on a chart. Let me go to charts, and we're going to just kind of take that $2.50 figure here on this. If I look at this and I say, hey, 250 plus 51.76 is about 53.76, 54 and just change, okay? And 250 minus 51.56 is a little bit below 50. This is the range that I need the stock to move out of for this, okay? This is the range I need the stock to move out of. If it moves more than that, I'll probably make money on this. If it stays within this range, I'll probably lose money on this. Now, question from Thompson Boyd. What's the expiration you should use? Typically, what you're going to do is you're going to go to an expiration that is just beyond what the expiration date of when earnings is. So in this case, we said earnings was the 15th. Here I'm going to the 17th. If I go here, this expiry is the 10th. We're going to be in and out of this trade before earnings ever takes place. Now, I can go out further, but if the purpose of this specific trade is specifically to target earnings, then we don't need to buy out farther than that. We can just go to the first one that expires after expiration. Now, there may be times when you're placing a trade and the goal isn't necessarily to play a move on earnings, but it's, hey, I just want to do a call option. I want to buy a call and think the thing is going to go up over time. And we'll see some examples of this. Earnings may kind of happen, but we're not specifically targeting earnings. In that case, we're probably not just going to go to the one just after earnings. We'll probably go sometime after that, whenever you would normally do it. All right. So to do this trade, I can just click on straddle, and typically straddles are done at the money. They don't have to be. Right now, our stock price and our strike price is about 52. We have a 51.50, so it doesn't really matter. The price is going to be about the same on these. And I'm just going to click on the ask price and notice what it does. It has me buying a call and it has me buying a put, both at the 52 level. And here's my initial cost on that, $240. So what I can do is I can click on confirm and send. And remember, you would only do this if I think it's going to move outside of that range. It gives me my break-even stock prices at expiration here on this, at expiration. So what does that mean? That means before expiration, actually, they probably don't need to go that far before expiration, because these break-even stock prices are just looking at intrinsic value of the options. It's not looking at extrinsic value. Extrinsic value is that component of the option that factors in time decay and implied volatilities, just the extra expense there. But as a target, just on a surface level, if you're just experimenting with this to start, let me suggest, look at this and play with it. Try it out. When I say try it out, I do not mean try it out in real money. I mean try it out on your paper money. You can play around along with me here on this in your paper money and do this trade if you want. Now, how do we manage this trade? Well, typically we're going to manage this trade by, as soon as earnings comes out, we're going to get out of it. Now, let's just say the stock went down, okay? Let's say the stock went down on earnings. Stock goes down on earnings. As we mentioned, if the stock goes down, we'll probably be making money, significantly at least. We'll probably be making money on the put. And the call, if it goes down a bunch, will likely be worthless at that point. If it goes down a little bit, the call may still have some value on that, but probably don't expect much, would be my message to you on that. Furthermore, we'll probably get out of the put at around that time, unless you expect the move just to continue to go down further and further, then you may decide to hold on to the put. If the call is truly worthless, you may decide, I'm not even going to bother getting out of it at that point. I'm going to just hold on to it in case it happens to take some fluke big jump and it regains some value. That's great. I'm not going to worry about getting out of that. But if if it's close to, even if there's some value in it, it may be worth it to get out of it at that point. The put, you can hold on to a little bit, but often those implied volatilities will go down, and that's going to hurt the trade there. Okay. So, question from Charles: what if the stock gaps down? How do you manage the risk? Well, let's say it gaps down. That's great. That's great if it gaps down, because that means our put, if it gaps down a lot, because that means our put is making money. Yes, we're losing money on the call, but as long as it moves outside of this range here, our break-even points, we're making more on the put than the call. Okay, I'm hoping that makes sense there. Similarly, but oppositely, if the stock goes way up, if it gaps way up, will likely, as long as it's outside that range there, we're making more on the call than we lose on the put. That's a good scenario. The danger is it doesn't move. This is a long straddle we're talking about here. Now, I don't want to spend the whole time going over this, because I want to go to some managing some option trades and looking at earnings and that context as well. But I just want to mention, if you specifically want to speculate, and this is truly a speculative trade, if you want to speculate on a big move on this, then this would be one possible type trade that you can do on that, specifically targeting earnings. Okay. So Barbara asked a good question. What are the specific conditions where straddles are most likely to be volatile? Well, and the question is, can we look, do volatile stocks have a better chance? Not necessarily, because stocks that have traditionally been volatile probably have a higher implied volatility, so you have to pay more for a straddle. If implied volatilities don't ramp up, then what you end up with is it'd be kind of like an easier trade to do, because hey, you could buy them for cheap and then you'd expect more movement out of that option. But the reality is, because you're having to pay for more, it kind of cancels out. So if there's something specific where you think a stock is going to move out, it can be a technical analysis thing. Maybe there's a resistance that you think it's going to be breaking, or it's not going to, there's no resistance close and you think it can move a long ways, then that may be the situation. Or whatever, maybe there's some fundamental reason or earnings reason or economic reason or something in the news that it makes you to believe that this is going to move a long ways. That's what this would be. Okay. Now, Trevor asked a good question. Can you get out of this trade pre-market or extended hours when the earnings numbers come out? Yes, but it's not quite that simple, because if you ever watch a company after earnings, and I'm just going to send this trade here. I'm going to put this in my, do I have a straddles bucket here? I'm just going to put in my long single options bucket here. And I'm going to put this trade in, and it hasn't filled, but we have an order on that. Trevor's question was, can we get out pre or post earnings? You can, but let's just look at this for example. I'm going to pull up Delta because they just had earnings. And I'm going to change my time frame on my chart. Okay, let's go to, let me just see, does this factor in? Did we have, may not be the best example here. But the gray area on this chart is after hours. Okay, the gray area is after hours. This is when earnings came out right here. So I'm going to zoom in. We're just going to zoom in on that little part right there. And you can see, and it's possible in this case, maybe it would have worked out for you. You see it jump up. You're probably not going to be able to react on the initial move. You're not going to be faster than some computer that can, react in a few milliseconds to the trade. So the initial gap, it's probably not going to help you on that. However, after that initial gap, if it continues up, then it may benefit you. But a lot of times it doesn't. And this is not a good example, but I watch a lot of companies that come out with earnings, and often they'll jump up and then they go way down. Okay. And if you get in right when it jumps up and get out of the one side and not the other or whatever, it doesn't benefit you. Okay. So I wish it were easier, but it's not. Trading after hours is not typically the path to making an easy trade there. Okay. All right. Okay, let's move forward here on this because I want to look at some of these. By the way, this is a little bit outside trade management, just briefly, but it's something that comes up occasionally. We don't see it that often, but it confuses people there. Okay. And thank you, Connie, for mentioning that. Options don't trade extended hours. So you can't do that extended hours. But even the stock trade, sometimes people will try and trade earnings and go, oh, if the stock goes up, I'm going to get out of that stock right after earnings. Okay. You can do that, but it can often reverse on you. But I should have mentioned this. Yes. Thank you, Connie. Options don't have the extended hours trading there that stocks do. So if we're talking about options in that case. So look at this company. And what you may see is, that we had this right down here. You see that right down there? That is a little symbol for a stock split right there. That's a 25-to-1 split, which is a very unusual split. That means this company used to be a very expensive company. Okay, very expensive company. This was like over a $4,000 company. And so now it's a lot cheaper. What happens to the options in that case, though? Well, let's look. Here's booking. Let me get out of the straddle and just look at single options. And what you end up with is a lot of times you'll see these like weird strike prices. You see this 180.8 for the strike price, 181.6. When you see these kind of weird strike prices, usually it's one of two things. One, it's either a split, such as we have here with booking, or two, there's some corporate action where one company has bought up another, and that's what's happened there. So this is one of those. Now, what if you had bought the option? Well, originally, this 181.2, I'm going to use my calculator on this, times 25, would have been a $4,530 strike price. Okay. So you still are the owner of that option at that point. Okay. You have 25 times the number of contracts. Okay. But the price has gone down by a magnitude of 25 times. Okay. Because of the 25-to-1 split. Most splits are going to be like 2-to-1 splits or something like that, or 3-to-1 or something like that. This one's kind of weird. But when you see these kind of weird strikes, that's often the case. It's a stock split. You still own the option, though. People sometimes wonder what happens to the option. You still got the option. The strike splits just like the stock splits. The number of contracts increase by the same magnitude there. Okay. So, but let's move forward, and let's just talk about some trades here. Okay. So, and in regards to earnings, we'll just kind of go through a variety of different trades. So we have earnings in 19 days on AMD here. Well, my option expires in 9 days. So if my option expires with 9 days and earnings isn't for 19 days, it actually essentially becomes a non-factor there. Okay, so that's the first thing to realize with earnings and managing existing trades. In this case, this is an iron condor. Okay, this is an iron condor. You can gain on both sides Typically, if you lose, you're only going to lose on one side. But the problem is the one side it can lose more than you gain on the other side. So with AMD, the stock has gone up. On the put side, we made some money. Okay. We made approximately $325-ish on that put side. The call side, not looking so hot because we're losing a lot more than we gained on the put side, on this call side. When we look at this, you can see here's the PL day, this column right here. This really got hurt today on this. And so what we can do is we can actually look at a chart on AMD here and see what's happened. Well, we had a nice gap up. I was kind of hoping that this was going to stay in this range and bounce down. Well, didn't do so. It gapped up against us. So what do we do with the management of this trade here? First of all, we're under 10 days to go to expiration. So regardless, we're probably going to look to get out. Okay. Regardless, we're probably going to look to get out of this trade here at this point. So you don't, on these multi-leg trades, a lot of times you probably don't want to get out of the whole shebang at once. It's harder to fill 4 legs than it is to fill, these 4 strikes here, the put, call. And so a lot of times we'll get either singly or as a spread. I can get out of the put spread, create a closing order, buy that back, okay, and send that order. And then I can get out of the call side of this. And we're just kind of taking our lumps on this trade. This one didn't, obviously didn't work out very well, but that happens, I guess. So we're going to get out of that. And so there we go. So I wanted to show you that one. Let's look at some examples. I want to give you different scenarios though today on these here. Let's go to single options. Okay, Bank of America, that's the one that this is what we just entered. This is the straddle. How are we going to manage this? On earnings day, typically we'll look to exit this trade. It's purely speculative. So I don't know if earnings comes out before the market or after the market. Bank of America, before the market that morning. So sometimes they're after market. Okay, that's before market. Before market on that morning, earnings will come out, and then we would look to exit that. But we're going to sit on that one for a little bit. Let's look at Caterpillar. Caterpillar is something that expires in 282 days. If you're doing a longer term trade, this is a leaps call. We're not going to get out before earnings typically, just because, hey, look, we're planning on being in this for months and months and months. And earnings is just a fact of life you got to deal with. This is true for stock trades as well. If you're in a longer term stock trade, you can't get out before every earnings. Well, typically you're not going to try and get out before every earnings just because they come out that frequently. So there is some risk in that, but we're willing to put up with this as long as we're still bullish in this. Now we have some sort of stop on this, but you can look at Caterpillar and you can say, am I still bullish on this trade? Yeah, I mean, the general trend is going up. So we're going to ignore earnings in this case, which is coming out in 16 days on that. So that's Caterpillar. Let's go to Capital One. This is a leaps put. Okay. Again, it's a longer term trade. The only reason we're buying a 250-day expiration is we're planning on being this for a long period of time. We have earnings in 9 days. As long as I'm still bearish on this, then I'm going to continue to stick with this trade. Let me just pull this up. Well, the trend has been down. Little bit of a gap up here. Is that a change in trend? Probably too early to say, But what we want to stop on this just in case it goes against us. I think we have a stop on here. See what we got. Exit when stock is greater than 205 is what it says. So our stop is right about here. That seems reasonable. Right about there. The stock is right there right now. And we're going to get out if the stock goes above that. Now, doesn't matter whether that's a traditional stop or a rules-based conditional type stop. It doesn't guarantee we're going to get out right when this is at 205. What if the stock gaps up to 220, 230, 240, whatever? So stops don't guarantee us to get out at a specific price there. We don't know exactly when that's going to get out. Okay, let's go to waste management. Again, here's a Leaps call, longer term trade. Earnings probably not a factor on this. I'm not going to worry about earnings as long as I'm still bullish on waste management. And we're kind of going sideways, longer term trade, so it's not the end of the world. We do have a stop on it of some sort. Let me just look at my note here on this. If it's less than 220, well, where's our stock right now? Our stock right now is at 228. So we're willing to hang in there a little bit longer, but we may not if things go south on this. Right now, we're up just a little bit on that trade. If it goes below 220, we'll probably be losing a little bit on that trade. But there you go. Okay. So just a comment in the chat from Trevor said, it's tough. I found it's better to go long short in after hours and then close out extended hours. I found the market makers. Market makers, there's a lot of volatility. Let's just put it that way. Extended hours especially, there's a very big volatility. When you're looking after market, if you just look at like a tick chart or a minute chart on a company, especially that's had earnings, sometimes you see wild swings that really don't have much to do with what the stock is going to open up at the next day. So that's why we don't even do that in our stock classes for the most part in these classes. Okay, let's move on down the list. I'm going to go and let's look at some others. Here's Apple. So Apple, I've got a stock. The option expires in 23 days. This is a covered call, by the way. The option expires in 23 days, earnings in 16 days. Okay. Earnings in 16 days. So earnings are going to occur before, if we were to hold this all the way to expiry, then we'd hit earnings before then. So that adds a little bit of uncertainty in this trade. Right now, we're doing fairly well on this. We've made money. However, the call's not doing great. That means the stock's probably gone up a little bit. We sold this call for 420. We could buy it back now for a small loss. But I'm a little worried that we're going to cap our upside, especially with earnings coming out. It's a 265 call. Well, let's look at Apple here. Here's Apple. Let's go past earnings on this. And we're looking at about a $10 move on this. Let's see, we said how many days till earnings? 16 days till earnings, okay? So actually, no, we're looking at about an almost $19 move on this. So if our strike price is 265, just the market maker move, the expected move could easily swing us well above our call. I don't want to limit us out on that with the earnings coming up. So therefore, I'm going to I'm going to stick with the Apple stock, but I'm going to exit that covered call here on this. Okay, so we'll take the $45 hit on that covered call and just look to exit that. So I'm going to create a closing order. We're going to buy that one back and just send that. Okay, so we are now out of that covered call. Because remember, on a covered call, you bring in the premium, which is great, but one of the downsides in the covered call is you limit your potential gains, which is fine. It's a calculated risk, but it may be that may be worth it at times. But in this case, especially with the potential for move, I don't know that that's worth it there. Okay, so I'm going to get out of that. Okay, let's move forward. Let's look at BlackRock here. Excuse me, Bank of New York Mellon. This is Bank of New York Mellon. We got another cover call. We're under 10 days to go to expiration anyway. So typically we do that unless we're just specifically looking to get called out. And that's a possibility. The current stock price is 127 bucks, almost 128 bucks. Our strike is 125. We can just let ourselves get called out on this if we wanted to, but I'm going to look to get out of this trade. And again, that cover call did not work out either, but that's okay. It's not a problem. If you're bullish on this, if you're still bullish on this, you can do that. If you're willing to get called out, then you can just say, hey, I made my profit. When we did this trade, we bought the stock at 68 bucks essentially. We've made decent money on this. So, it's just what your intention is when you enter the trade in the first place is, I don't want to move that to group, is the what you're going to stick with. So if we said we were going to just get called out, we can do that. Otherwise, we can look to get out of that covered call on that, okay, with earnings coming up. Now, we're not always going to do that. But let's go and let's look at some others. Here's one. Microsoft. Microsoft is a front ratio spread. Okay. It is a front ratio spread. Now, I had a question that came in on my X account on a back ratio spread that it never filled, if whatever that order was, the one that you referred to. But the point is, how do you get out of these? So I want to talk to you about how to exit these trades. This is more of a complex trade. And you may decide you want to get out if you or not. If it's confusing, and this can be confusing, if you're looking at a more complex trade, if you have more shorts than longs, consider what that extra short does. If you have just a short put, that gives you a lot of risk on the downside. Well, let's look at Microsoft. So the way to manage it, if you don't understand it, is to look at that Analyze tab. Here's Microsoft. And we can see, here's the current stock price. And if it goes down, we could benefit. If it goes down a whole lot, then it can get really troublesome. So if I'm a little bearish, I may stick with it. If I'm bullish, it doesn't get any better. Let's look at Microsoft again. Again, the general trend has been going down. So from a purely technical standpoint, I'm going to consider this to be more of a bearish trade, even though we have some bullish momentum right now. So if it's a bearish trade, we could say, well, I'm going to stick with this a little bit longer. So I'm going to stick with this. But if you want to get out of this trade, just let me back up one second. There's not that much risk if it stays high. I may lose a little bit more money, but you can see if the stock goes up, we're basically close to our break-even line. it's probably not going to get that much worse. So I can stick with it for a little bit. If it goes down, it gets a little bit better. Okay. So I'm willing to stick with it for that point, for that reason there. Now, if we did want to get out of this, and this goes to a question that was on X regarding a back ratio spread, but the same thing is true for a front ratio spread. If we want to get out of this trade, typically you're not going to get out of everything at once. Technically, you can highlight it all, create a closing order, and do it this way. But it's harder to get filled on these unusual type spread configurations. Therefore, what we'd probably do is we'd probably get out of the put side first, just create a closing order on those puts, and then you can send that. I'm not going to in this case. Get out of the puts and then get out of the call in that case. Okay, I am out of time, folks. There's a few other trades I wanted to get to here, but let me just mention, for most of these trades, if we're under 10 days to go to expiration, and I have several of those here, we're probably just going to look to get out on those trades there. So thank you for joining me today. Coming up next, we've got trading price patterns, everybody. So I appreciate you joining me. Thank you, Connie. Thank you for your questions. And everybody, have a wonderful day, and we'll see you same time next week.